the Property Secrets, our new podcast. And we're also going live on Facebook. So I'd like to introduce Adrian Cartland from Cartland Law. Adrian, you're a tax specialist, and when it comes to property tax in general, you're a genius. Some people have said that. And you've created some amazing results for some of our members too.
Mm-hmm.
Yep.
Yeah. So I've been doing a lot of land tax work for the last 15 years because it's the quintessential way for people to build wealth through property, and that it's also a quintessential way for governments to tax. So governments like taxing property because it's there and they can see it. It's and everyone has an opinion on it. And what's happened in South Australia, as the state governments have wasted their money on various things, and they've tried to look to land tax to fill the gap. And so in South Australia, we've had a number of problems and changes to land tax over the last, particularly 10 or 12 years. So, and that have all related to holding multiple properties.
Mm-hmm.
So back before 2007, it would be really common. The common way you'd buy a property would be you'd hold 1% in someone's name and the remainder in say a trust name, and then that would create a different set of people who are owning it. So what would look at is person A holds 1%, person B holds 99%, and then next one is B holds 99% and C owns 1%. What used to happen is that you'd have A and B as one taxpayer and B and C as a second taxpayer. Mm-hmm. And then so it would be as if it's held separately. And that matters because in land tax, it's progressive. So it starts off with a tax threshold, and then so you don't pay land tax below that. And then going the higher the higher amount of property that you own, the higher the threshold. So the higher the rate of tax. And South Australia has had the highest rate of land tax in the country for some time. So it's particularly problematic here, and so there's been a need to disaggregate. So some of the big problems started when they got rid of the 1%, the minor interests, and then they started looking at different problems with trusts and trying to look at trusts and say, this trust is a different one, but no, we're going to treat it as if it's the same. We've been dealing with this problem, and now they've come through and they've enacted legislation that will sort of deem property to be owned through companies and trusts. They're trying to look down at an individual and say, this is yours.
Yeah,
that's my sort of over now. That's what's been happening. Maybe do you want me to start with what's how land tax works, and for someone who's just starting off buying property? Or
what I was going to do is I was going to ask you questions, and if you can answer them along, because I know because what's happening since the land tax debacle happened, I've been getting emails, SMSs, phone calls. So I've got a list of questions that people are interested in.
Cool.
And I thought that'd be the best way. But I want to just, an analogy. I wanted to say analogy while we're talking about this is, for example, it's a bit like, registration. When you got multiple cars, doesn't matter who the owner is, you get paid. You just pay per car. And what the government's now doing is they want, if you own 5 cars, you need to pay a lot more than just one car, an aggregator.
Yeah.
But unfortunately got through. I don't know how it got through. We fought it for a while, but it didn't happen, and it got through. Luckily, they watered it down a little bit. So there's different states and how they handle land tax. And like Victoria and New South Wales, for example, they handle land tax differently with the aggregation and the trusts, but also got higher thresholds. What are we more like? What's the new? Let's talk about the new rules now of what's going to happen. And
we're closer to Victoria, and I say that because of how what the definition of a fixed trust or a unit trust is in there. So you get taxed. So there's in South Australia, there's essentially 2 different types of trusts that matter. One discretionary trusts that existed before the legislation was introduced, two discretionary trusts that come into the future, but really the difference between discretionary trusts and like unit trusts or fixed trusts, where they can say this is the person who owns all of the units and carry down. So what happens is we've got a broader, and this is one of the things that like the submissions, like there was a number of submissions, including I put in submissions stating that here's some problems with the legislation as it was initially drafted. One of those big problems was that it didn't really define what a unit trust or a trust is. One of the things that New South Wales that is very problematic is that you're going to pay the penalty tax for land held in trust if it's not a fixed trust, but which has a very, very specific definition under New South Wales law, like totally devoid from understanding of actual trust law. They just sort of made this stuff up, and so there's a terrible problems. Victoria is better in that it's more flexible or more realistic in what constitutes a fixed trust or a unit trust. And so that's why I say South Australia is more like Victoria in that it looks through to who is the ultimate holder of the trust, or that's what it's supposed to. And because of these changes, we're not under such an oppressive regime. It's something that we can actually deal with.
Yeah, okay, excellent. And I mean, look, at the end of the day, the reason we've got someone like you as our circle of safety, when new legislation comes in, your job's to find ways of working with it and minimising the downside.
Yep.
And I'm pretty sure that you've got some great workarounds in helping us minimise the downside.
Yeah. So let's start.
So I know that the people at the top, they're going to save a lot of money. Because if you got $10 million worth of land, you're going to probably save about 30% on your land tax, which is a lot of money. So they're all fine. But the people in the middle are the problem, the middle class, and they're the ones that normally get attacked by government. They're the ones that pay most of the tax. And I think what's going to happen to the average family if they do nothing, and can we help them?
Yes. So you've got 18 months. So the default way of holding property, maybe your second investment property onwards, is in a discretionary trust. And the reason why you do that is for asset protection and for succession planning and for tax streaming. So let me go with the asset protection. Just say you're working as an accountant, and you, like anyone who's a professional, has a risk of being sued. Or anyone who runs their own company has a risk of being sued. And so you don't want to have assets in your name. You want to have them in someone else's name. So you might have them in your spouse's name, or alternatively, you have it in a discretionary trust, and you don't actually own any part of a discretionary trust. And so that means that if you went bankrupt, you don't have an asset that can be taken. So structuring asset protection 101 says hold passive assets like property, particularly if it's positively geared, in a discretionary trust.
Absolutely. And I mean, we're the second most litigious country in the world, aren't we? After USA?
Yep.
Yeah. So like people are getting sued left, right and centre. So you've got to really cover your ass. And I mean, there's no point building a property empire unless you protect it. And protecting
it's not
is very important.
Expensive or difficult to do it. But where it's problematic is like when the government changes the rules. And what's happened here is that people have followed, basic structuring for a number of years.
Since the early 1900s, wasn't
it? Discretionary trusts really became popular in Australia in the sort of 50s and 60s. Were useful for getting around death duties and gift duties, but really picked up in Australia for the reason that you can distribute income. For example, basically these are useful for getting around problems in our tax system. Now, when you're a husband and wife, say you have you share all your income. You don't have this is the husband's income and the wife's income, and he only spends his income and she only spends hers. It's like, no, you pool your resources. So practically you share. Well, most people do. And So, but what's weird is just say, he's earning $200,000 and she's earning $50,000. They're going to be taxed on totally different tax rates. Now that's just weird. Now let's just
weird,
yeah. So if you have a property and if you're getting something that's generating revenue, say from a property, you're going to want to distribute it to whoever is on the lowest tax bracket.
Exactly. So yeah, absolutely, totally.
Yeah, and this is just tax structuring 101. It's not exotic. It's something that everyone does, and it's to get around this sort of fiction of treating different members of the same family who pool their resources as being separate individuals. So that's why. So most people will hold passive assets in a discretionary trust for those couple of reasons: for asset protection and for tax structuring. And so now, so when you go and buy, generally when people buy their first property, they haven't thought through that, or it's not that big of an issue, so they'll buy it in, say, their spouse's name if they've thought through it. But then when you start to buy another couple, you buy it in, say, a discretionary trust. You start getting some proper advice. So now the problem is that this discretionary trust that you would have set up for asset protection and federal income tax, now in South Australia, you're going to have to pay a penalty amount of land tax, which is just problematic. It's punishing people for being, for something that's not has anything to do with land tax.
Yeah, it's crazy. So now. So you said we've got 18 months now to comply, or?
Yeah, so there's something that's really important for everyone who has a discretionary trust. You have 18 months to nominate who the beneficiary of that discretionary trust is. Otherwise, that trust will always be taxed at 0.5% higher. So that's like, if you're making 5% a year, that's like 10% of your returns, that you lose. So like 0.5% increase in land tax if the trust doesn't have a nominated beneficiary.
It's 10% of your gross return, not even your net return.
Correct, yeah.
It's probably all your net return and more. That's the problem. Because with property, I mean, the strategy of property is you hold it, and over time, 7, 10, 12, 15 years, it doubles. And the problem is it's hard to hold. So, yeah.
Yeah. So what you need to, when you need to make an election if you own property in a discretionary trust within 18 months. Now, if you don't, it's always going to be taxed at this higher rate. And one of the problems so every person who owns property in a trust needs to get advice about their structuring within the next 18 months. And so not only do they need to, they can't just consider who's going to make that election, who they're going to give, like, say, is the ultimate owner of the property, but they also need to think, like, this will have other implications. So let's just say you have two properties, and you have two children. If you give property 1 to child A and property 2 to child B, if that's your succession planning, but if you make the elections the other way around, they're going to end like one child's going to be entangled with the other. In fact, do you want me to draw a diagram of this?
Yes, please. That'd be great. I think a visual will become in handy, because I think we may have lost a few people here. And
yeah, sure. So can you see my screen?
Yep.
So let's just say we've got a discretionary trust number 1, and it's got a trustee. So a discretionary trust is a sort of a strange thing when you think about it. It's actually two pieces. There's a trust and a trustee, generally say a company trustee, that holds property on behalf of the trust. And so in this case, it owns, say, Blackacre.
Mm-hmm.
And this one owns Blackacre. And then over here, we've got trustee number 2. And this owns discretionary trust number 2. Well, this is the trustee of it. So together, the trustee plus the trust is the trust. And this one has Whiteacre. And now you have now 2 children, a son and a daughter. Now, what's going to happen is you need to make a nomination as to who is the beneficiary of this trust. So say discretionary trust 1, you need to pick a person.
Yep, and that's to avoid paying the extra 0.5%, correct?
Yep.
Now, can you change it in the future, or once you nominate it, that's it?
Once you've nominated, you're stuck with it. And
wow, so it's not very discretionary, is it?
No. And so this is why you really need to think through it. So you're going to have to make this nomination, and to work this nomination out, whoever you nominate, it's going to look at any other pieces of property that they own, and it's going to treat them as if they own all these properties together.
Wow. So this is like, once you do it, you're stuck with this for the rest of your life, unless you want to pay a lot of money to move things around.
Correct. So it's kind of like as if they own it. So it's
what about income distribution? Is that going to affect that as well?
No, it doesn't affect income distribution, and it doesn't affect their like the asset protection. It doesn't it doesn't affect like any other parts of the discretionary trust. Only land tax.
Yeah.
But once you give, but you get a one-off chance. If you started a discretionary trust tomorrow and bought some property, you can't make this nomination. It's only a grandfathering thing. So for only people who had it as of a couple of weeks ago when the legislation was passed.
Wow, okay. So what happens to the people in the future? They're going to have to just...
If they buy it in a discretionary trust, they're going to always pay this 0.5% extra.
Mm-hmm. All right, okay. But I mean, is it worthwhile for certain things?
Pardon?
Is it worthwhile to pay that extra 0.5% so you got the flexibility? I'm just curious. I mean, what's the downside? What's the upside? Because the land tax in general has gone down there, hasn't it?
Can I come to a really good example in a second? I've got some numbers set out that I'd like to show you, but I just want to finish off with this. You got to think through. So the important thing is not only just calculating the land tax, you've also got to think through your succession planning. So, for example, if I left this Blackacre to the son, and then or made a nomination of Blackacre to the son, but later on, like the daughter wants to live in there, and I want to, in my will, I transfer the ownership of the trust through giving her the shares to the daughter. So then she takes control over it, and she makes she's the appointor. Give her control over this. Suddenly, her land, like the son's land tax, is going to be dependent on what the daughter does with this property. So you really need to. You can't just think through land tax. You're going to think through, who am I going to nominate? So you want to say, like, if the daughter's going to get this property, do I nominate her instead? It might be better to nominate her. And then, so you have to think through that. Similarly, you might go, I've owned a few properties. I've got a couple of kids. I'm going to nominate my son and my daughter to be the beneficiary, to be the owners, or nominate my son and daughter for these properties for land tax purposes. But then suddenly, the daughter then goes and says, I'm going to buy some property of my own, and it's going to be aggregated with this property that you've nominated her for. So suddenly she's paying higher land tax because of the parent's nomination. And the parents,
can I ask you a question? But I mean, if the daughter or son buy a owner occupier, it's not going to affect anything. But if they buy an investment property, it will make a massive difference. Correct?
Yep. Definitely. Yep.
Yeah. So really, if you nominate one of your kids and a property, if they get investment property, it's going to be harder to be positive geared, because it's going to be a lot more negative because you're paying extra land tax.
Right. Yep.
Yeah. So really, what's happening is it's stopping South Australians from buying more property in South Australia, punishing them. However, it's allowing people from interstate to buy property of impunity.
Yep. So you know what you might do is you buy your first property in South Australia and your second property in Queensland and your third property in Victoria and so on and so forth, and then they don't get aggregated together.
Yes, and I look, part of the strategy of what I use anyway is I like to go on a global scale, and I always follow the clock, the property clock. And at the moment we're buying in Brisbane, but we keep moving around. But once you've done it a few times, then you're stuck because you've got all these properties. Good problem to have, but then you've got to work out different ways of doing it.
Yeah, so the like it diversifies your portfolio, so that, like it might be a good thing. I mean, what it is as you say, it's discouraging investment in South Australia.
Yep. So what do we do? I mean, we've got some members on our program have got 10, 14, 15 properties in Adelaide.
Let me give you a 10, 14, 15 property example. I'm just going to change the sharing.
Yes, because you and I have spoken about a calculator that you're making.
Yeah, so what I've done is I've got a spreadsheet sorry, can you see this?
Yep.
Now, this is an example. 10 property is just $250,000 land value each.
Yep.
Yep. Cool. So I've created a spreadsheet for my own internal purposes for this kind of calculation. So I've done so much of this already before the legislation's only just come in. But I'm turning this into a tool using some bit more fancy computing power, and we're going to put this on my website early next year. So it's built, but doesn't have great user experience. So it works for me. But let me show you the output, and then early in say January. We can share this and so that people can do their own calculations.
Excellent. So people watching, what I'll do is I'll be sharing a link of this in January in Property Secrets, our Facebook group, because that's where most people go on a regular basis, and that you can get it there. So if you're not a member of Positive Secrets, I suggest you join, and it will let you know once you get involved.
Fantastic. All right. So here's this. So can you see on the screen? Let's say there's 10 properties with $250,000 land value each. Now remember, so land tax is calculated on the land value. So what this actually means is that it penalizes people who have, say, older properties or less developed properties. So they have a large block in McGill that they haven't subdivided, and it's got an older house on there. They're probably not getting great returns on. Those are the people that that are going to be paying land tax the most, because it's going to be a lot of tax, and they're probably probably a low net value. And also note that there's being a revaluation of properties at the moment. So the value general is increasing all the values. So
the Liberal Party has been decreasing the values of Australian Adelaide property, but the value of general is increasing. How funny.
Bless them. Yeah. So let's just say you've got someone who has 10 properties of $250,000 value each.
Yep.
So the current amount of tax, if they were all aggregated, so you had $2.5 million worth of property under 2018, 2019, you'd pay $57,000 worth of tax.
That's a lot of money.
Yeah. So it's pretty bad.
It is, and I've met so many people in Melbourne, and that have got this exact problem, because Melbourne's land tax is very similar, and and now we're going to have the same problem here in South Australia.
Yeah. So, like I said, we've got the highest rate of land tax in the country at the moment, 3.7%. Now, the way of fixing this is what everyone's been doing for the last 30 years. Is you have one title per discretionary trust. So you get a new trust for every property you buy. So if you had one of these $250,000 properties in every trust, the amount of tax you pay is nothing, because it's below the land tax threshold.
Yep.
Now, actually, let me show you here's the 2019, 2020 tax rates. So between 0 and 390,000, you pay nothing. Then 390 to 716,000, you're paying 0.5%. Then it goes up to 1.65%. Then between 1 million, 1.3, it's 2.4%, and then 1.3 million above, 3.7%. Crazy.
Yeah, it's very expensive. 3.7, I mean, that's higher than what you pay the bank for the land.
Yes.
Because at the moment, I mean, people are paying around 3.5% on their, some people are paying that much on their loans, and we're actually paying every year to the government more than what we're paying to the bank just to have property. Crazy.
So the new rates are going to be 0 to 450,000, nothing, 450 to $755,000, 0.5%, then 755 to 1 million, 1.65%, then above 1.098 million, 2.4%. So that's property that's with it that you own in your own name, or that where there's been a nominated beneficiary. So it's held by a trust, but then that's been nominated. There's a beneficiary. Now, if it's owned in a trust, it's going to be 0.5% higher, up to 2.4%. So
yeah, let me ask you a question though. I mean, are the trusts aggregated? Because I mean, if you're paying 0.5% for being in a trust and it's not aggregated, then it's not that bad.
Can I come back to that?
Yes.
Yeah. Let's come back to this in the example. So, so now we've seen these rates. That's their current tax. So now let's just say, so they've decreased the headline rate. So this means that if all of the properties, those 10 properties, were now owned in like all aggregated together, you'd pay $40,000. So it's actually less than 57. So you know, if you own a lot of, as you know, and this is
still very expensive though.
Like, yeah, and it's more pronounced, you know, if you're owning a shopping center that's worth $100 million. You know, as you said, the big guys, they're the ones that do really well out of this.
Yeah, because they're going to save money. Yeah.
So when you're hitting that headline tax rate of 3.7%, when it goes down to 2.4%, like that's saving people money, but only if they're aggregated. Okay, so the problem is that you probably wouldn't have them all aggregated. You wouldn't have 10 properties aggregated.
No, the only thing I mean, just the really expensive land you can't do much about, but otherwise, yes. So, and if aggregated, it'll be 46,000, so back to normal.
Now, if it was all aggregated at the trust rate, it would be $46,000.
Yep.
So this is the effect of having a 0.5% increase.
Yep.
But now let's go through it. And so about aggregation. So now let's just say you purchased each one of those 10 properties in a discretionary trust and you didn't make a nomination to anyone. Okay, so you're just paying, all you'd be paying is 0.5%. And so you'd pay $12,500 tax.
Yeah, so still a lot more than zero.
Yeah, exactly. So it's better than 46,000.
Much better than 46. Yeah.
So now, and here's where the planning comes in. Like you might be able to like find some people to nominate. So just as an example, if you said if there was 2 titles per discretionary trust and you did 5 different nominations, so you just say you had mum, dad, 3 kids, you know, or mum, dad, nonna, pop, you know, and a child, you know, so 5 different people you could nominate to, then you can bring it down to $1,800.
Yeah, so basically with real clever tax planning, and as long as you've already got the trust in place, does this preclude, because if you have got the trust in place, you're going to be the first example because you can't nominate anyone, is that correct?
Correct, yep. If you don't have trust in place, or if you were buying property now, you would, it's going to be 12.5%.
Yeah, so as I've been saying to people, I mean, don't buy a property in Adelaide until we know what's happening. And now at least we know. And once you've got the calculator out, before you buy a property, we can go in, check the calculator and really do a proper cash flow calculator. Because what we do is when we buy property, we like to do a cash flow calculator to find out exactly what it's going to cost you per year or per week. And now we're going to add this new thing because, you know, you might be positive, but suddenly if you're paying another 12 grand or 40 grand, you're going to be negative. So you've got to be really careful.
Yep.
With your numbers and the due diligence. We're going to have to just be more due diligent with this.
Yeah, exactly. Now, there are some other things you can do. So this is just using a discretionary trust. So let me give you some structuring ideas. So when you're thinking through your discretionary trust, you're going to need to think your asset protection, like what happens if you're going divorced, your bankruptcy, whoever you're nominating, you need to think through all of these things, your estate planning, your income tax, purchases, maybe Centrelink. It might affect you for Centrelink purposes. Now, I think the new structure for purchasing your first or second or investment property will be a unit trust.
Yep. So, which is quite common in a lot of places anyway.
Very common. So now in New South Wales, they require them to be fixed. But here, you now don't need it to be, doesn't need to be fixed. It just needs to be a unit trust. And so you can have, and it's going to be taxed on whoever has the capital units. The capital unit holder is going to be the beneficiary. So now what we can do is we can have corpus protection units. And so let me give you an example of this. So let me just share my screen back for pictures here. So let's say you're, so we're going to have a unit trust. I'll just get my drawing working. So a unit trust is like, it's kind of like a company in that it owns property, and that there will be some unit holders who will own the units, just like you might own shares in a company. And so whoever owns those units are the owner of it, as opposed to a discretionary trust where there is no particular owner of it. Okay, so let's draw a unit trust, and this is going to own some property. And then here we're going to have a husband and the wife. And let's just say the husband, is an accountant or a professional, and they're a director of a company somewhere, and they could be potentially at risk. Let's just say that the wife purchased the first property in her own name, because that's generally what you do for investment structuring, because it's, she's not at risk, she's going to own one property. But then you're going to go, property number 2, I want to own in the husband's name, because that way that's going to be separated. So then they're not going to be aggregated together. So we have the capital units owned by the husband. Now, ordinarily, property number 2, you'd own it in a discretionary trust.
That's right.
But now we can't do that, because we can't establish new trusts if we want to, new discretionary trusts, without getting the land tax surcharge on trusts. So no discretionary trust. So we're going to give him the capital units. And then her, we're going to give protection units. But that doesn't give her any right at the moment. And I'll just explain how this works. Because he owns all the capital units, we need to inform Revenue SA with some nominations that he's the owner. And so therefore he's going to be treated as the owner of all of property 2. And she's going to be, she's the owner of property 1.
Yep. And how do the protection units come in? What do they do?
Yeah. So what happens is the wife has no rights until if he ever gets sued or is in danger of going bankrupt, then his capital units wink out and they disappear.
Very clever.
Yeah, and then
she ends up with the capital units. You pay more land tax, but you don't lose the property or get sued for it.
Correct.
Brilliant.
Yeah. So, and that if it's set up like that, that won't trigger stamp duty, because she would always have those rights. You know, stamp duty.
That's the important part, because you don't want stamp duty when you're transferring properties.
Yep.
Well, that's very clever, very smart.
Yeah.
So look, so obviously there's ways around it.
Okay, do you want me to do another one?
Yep.
So another one is we have let's say someone's purchased property and they've purchased it in their own name. Or, you know, maybe they've purchased it in a unit trust, but it's ultimate and they've been nominated. And we want to say, well, now they're at risk. So sure, this is going to be good from a land tax perspective because it's not going to be aggregated. But how are we going to protect this asset? So we set up a discretionary trust, and you know, with a trustee. What we're going to do is we're going to so part of this property is going to be owned by the bank. Well,
that's correct.
The bank, but
probably 80% of it.
Yep, let's say 80%. Now, what do we do for this other 20%? And that's really their asset. What we're going to do is we can put an unregistered second mortgage, and mortgage that property to the discretionary trust. And so what happens is the discretionary trust pays him for the second mortgage, and then we just gift that back into the discretionary trust. And that's totally fine to do, to gift money into the discretionary trust. And then so now all like the value of the equity is in the discretionary trust.
Yep.
So that way, if he goes bankrupt, he's got nothing. The discretionary trust will call on its second mortgage. He has no assets, and you've saved your assets.
Yep. Excellent. Yeah. So look, I think what people need to do is, if anyone's got more than one property in Adelaide, they really need to check out your calculator or even have a review to find out what's the best way forward. And especially if you're planning on buying property in Adelaide going forward, you really need to look at what you've got, how it's going to affect you, because it's a lot more complicated than you think. It's not simple and it's not like the old days where you just buy a property and it wouldn't make any difference. There's a lot of complexity involved now. And what I'd like to do, Adrian, I'd like to do a second session with you about asset protection and talk to people about exactly how you can protect your assets around Australia and what's the best practices when it comes to, you know, the second mortgage and discretionary trust and all that sort of stuff. I think that would be very valuable to do it on its own as well.
Sure. So do you have some more land tax questions then? You got a list?
Okay, so I've just got a list of what people have been asking, and I guess most people what have been asking is, what is the land tax and how's it going to affect me? And we can't really answer that until we got the calculator out and people will look in the calculator and do it. So I think
so people have got amounts of land tax. So this is what you need to do. You need to calculate all of these things. You want to sit down. It's actually an important exercise, not only working how much land tax you're going to pay, but thinking through this whole piece. Where is the property going to go to? Is it going to go to my son? Is it going to my daughter? Do I need to move into a discretionary trust? It's not just land tax. Because you're going to have to change through ownerships and think through this, you need to think through land tax and income tax.
Is that going to affect people? So, for example, let's say I've got a nephew, right? And I've got a discretionary trust and I nominate him. How is that going to affect him and how's that going to affect me? I mean, one, it's going to affect me because I don't have to pay land tax on that one.
Yeah,
but when if he buys an owner occupier, he's fine. But if he wants to buy an investment property in Adelaide, then that's going to affect him, correct? But it will affect his tax at all.
That property, yeah. So let's just say he owns, it's $250,000 worth of property, so it's below the threshold. You nominate him, and then it's suddenly as if he owns it. He goes out and buys his first investment property and buys it in his own name, say. Then suddenly that $250,000 is going to be added to the value of his new property. So now he's suddenly going to be paying at higher rates. So it's going to hurt him. Yeah,
but it's not going to affect his tax situation at all, though, is it? In the meantime,
it's not going to affect his land tax situation until he has more property. So
and also the income of that property is not going to be affecting him either, is it?
No, he won't get that income.
No, that's separate.
It shouldn't matter for Centrelink purposes either, but Centrelink's kind of weird. So just be careful about that. So theoretically, if you nominated your nonna, and you know, she didn't own any property or any investment properties, she just had her, say, main residence. You nominate your nonna, and from your discretionary trust, and even though it's not a discretionary trust that she gets any income out of, I would say that that shouldn't affect her pension.
Yep.
But we can't be certain. You know, Centrelink can be problematic with this. I don't know how they're going to react. I would assume that they won't. That it shouldn't affect her law, but they might think through it.
Yes. So obviously, you know, assuming they won't is not quite enough for people to do something.
Yeah.
So just wonder, how would we get a different? Is there a way of reversing it? Let's say, for example, you nominate your nonna, then suddenly go, nah, sorry, you can't have the pension anymore. Your nonna's going to be distraught. She's not going to be happy. What do we do in that situation?
You can revoke it, but then you can't nominate anyone else.
Yeah. Okay. So there's ways around it. So you can revoke it, and then you're paying the extra 0.5% worst case scenario.
Right.
But at least you're still getting a pension. So there's ways around it. And I suppose until someone nominates their nonna and we see a a case study, we're not going to be able to sure until.
The real question is how would Centrelink find out?
Of course.
Like as soon as you nominate her, she's not going to it's not immediately going to be data sharing. Now there is often data sharing between government departments, so you should be very careful about that. But to my knowledge, there isn't a fantastic data sharing between Revenue SA and Centrelink. Whereas there is really good data sharing between, say, the Australian Taxation Office, which does with your income tax, and Centrelink.
Yeah. ATO data share, they like to get data from everywhere. They're quite good at that. Yeah. Okay, so I think for everyone watching this, one thing you've got to understand, it's complicated. Two, I really think if you've got more than one investment property in South Australia, you need to come back in the group in January when we launch the calculator. And what I'd like to do, with your permission, Adrian, I'd like to do another, once you've got the calculator ready, what I'd like to do is maybe run through 2 or 3 real life examples. I'll delete the names, but people that I've actually got in our group. So that way we can actually show people how to work through it and how to actually reduce your tax in a real life example, which will come in handy because we can do some great work for some people and members in our group. So people, if you've got more than one investment property and you want to be an example without your name being shown, reach out to me, and what we'll do is we'll take your details and we'll go through the.
And so we use this calculator ourselves internally. It's just there's a difference between having a tool for my own use and something that other people can use in an intuitive manner.
Absolutely, and I think once we show the example, people with very simple situations can probably work it out in the calculator. However, anyone with more complicated situations, we're going to have to see someone, and I suggest if you see someone, see Adrian, because Adrian's probably on top of this more than any other lawyer in South Australia. Like a lot of them don't know what's going on, but you really know what's going on, Adrian, which is very important.
Thank you, George. Thank you. It's always a pleasure to work with you and see all the people that you're helping in property.
Excellent, excellent. Well, thank you so much for giving us your valuable time and your insights. If anyone's got any questions, please type below, and we'll get it ready for our next interview. And Adrian, Merry Christmas. If I don't see you before, and have a great end of year.
Fantastic. Thank you, George. Have a Merry Christmas.
Cheers, mate. Bye-bye.
Yeah, bye.